The 401k tax trap that activates the moment you die is one of the most overlooked wealth destroyers in retirement planning. You spend decades building that account, you pay taxes on the way in or defer them on the way out, but there's a third tax event that most people never see coming, and it lands entirely on the people you love the most. Hi, my name is Philip Ramsey. I'm the president at Uncommon Wealth Partners. I want to tell you about a client I've worked for whose father had done everything right. He built a $900,000 traditional 401k over 35 years, lived very modestly, left it all to his 2 adult children. What those kids inherited wasn't just money, it was a ticking tax clock. No one had warned them. Today, I'm going to show you exactly what that and how that trap works, and what you can do right now while you still have time to keep it from detonating on your family. Here's what I want you to walk away from this video. There was a law passed in 2019 that most retirement savers never heard of. It's changed the way that your heirs can do to your accounts after you're gone. And if you have a estate plan that hasn't been updated since then, there's a very good chance that you're leaving your family a tax bill and they are completely unprepared for. By the end of this video, you know exactly what changed, who this hits the hardest, and what to do about it today. So stick with me. Let's start with the most people believe about leaving money in a retirement account to their children. The assumption is that the kids inherit the money and they start distributions gradually over their lifetimes. Everything is stretched out over decades in the same way that it would have for you. Now, that is exactly what the law was for a long time, but it changed. And if you haven't updated your plan since 2019, you may be operating on the rules that no longer exist. Here's what's changed, and it changed fast. Congress passed the Secures Act in 2019, and for most non-spouse beneficiaries, adult children, and other non-spouse individuals, the stretch rules that has existed for decades are now gone. Under the current law, most non-spouse beneficiaries must fully distribute an inheritance retirement account within 10 years of the original owner's death. 10 years. And depending on when the original owner passed, whether they have already begun taking distributions, there may be an annual withdrawal requirements built into that period, not just flexibility to wait until year 10. Either way, the clock starts running the year after the original owner's death. Think about that and what that means in practice. If you leave your son or daughter $700,000 in a traditional 401k, they don't get to take out small distributions over 30 years at manageable rates. They have to empty that entire account within a decade. So $70,000 a year if they spread it out equally. Every dollar is added to their ordinary income that year. And here's the part that makes this genuinely painful. If your children are in their 40s and 50s, when they inherit this, they're likely to be in their peak earning years. They may have already be in the 22, 24, maybe even 32% federal tax bracket. Now they stack those mandatory distributions on top of that. The tax bill can be substantial year after year for a full decade. Now here's where things get interesting. Think about what you actually leave to your heirs. When you leave them a traditional 401k or an IRA, you're not just leaving them the full dollar amount, you're leaving them the full dollar amount minus whatever the IRS claims after they pull it out. That gap between each account balances is what you actually are giving to your kids. It's a trap. Most people have no idea how wide it can be until it's too late. Now, the question I get at this point is, what about my spouse? Now, the rules are meaningfully different with your spouse. A surviving spouse can roll those inherited accounts into their own IRA, and they can delay RMDs under their own timeline and manage those distributions over their lifetime. The 10-year rule genuinely doesn't apply to them, to the surviving spouse. But here's what most couples miss. The moment that surviving spouse passes or graduate, as we like to call it, Uncommon Wealth Partners, the account transfers to your adult children and the 10-year clock starts. That's the second wave of this trap, and it's the one that catches most families completely off guard. If you want to see how your beneficiary designations play out across both death under today's tax law, book a time with me at Uncommon Wealth Partners. The link is in the description below. Now, let's talk about the one account type that diffuses this entirely. A Roth IRA or a Roth 401k passed to a non-spouse beneficiary is still subject to the 10-year distribution rule. They still have to empty out the account within a decade, but here's where it's different. Those distributions are generally tax-free. Every dollar that's pulled out is income tax free. The 10-year clock becomes largely irrelevant when the account carrier has no tax liability. This is not just a retirement income argument, it's a legacy argument. And it changes the math entirely when you leave behind a Roth IRA or 401k Roth IRA. So here are the 4 moves that matter most while you still have time to make them. Step 1, audit your beneficiary structure. Super important. Pull out every retirement account or every account you have and look at who is named beneficiary. Then ask one question. If I die tomorrow, who does the beneficiary, what is their tax situation at, and what does this 10-year rule do to them? Again, the spouse is different. Now, when your kids are in their completely the best earning years, that's a problem. You can do this, and you can do this for your kids. You can just think through of what you're actually leaving. Step 2, match the right asset to the right heirs. Taxable brokerage account receives step up in basis at time of death, meaning your heirs inherit them at current market value with embedded taxable gains. They're all largely wiped out. Retirement accounts get no step up. Every dollar that is ordinary income. Directing pre-tax retirement assets toward a spouse or charity and taxable account toward children can meaningfully improve your family's actual keep. Step 3, consider using your retirement accounts for charitable giving now. Individuals age 70 and a half or older can make qualified charitable distributions, QCDs, directly from an IRA, up to an annual IRS limit. Index for inflation each year, blah, blah, blah. One important note, QCDs are only available from IRAs, not directly from a 401k. If your savings are still in an old 401k, you need to roll them over to a traditional IRA first, and then a QCD satisfies your RMD. Keeps that money out of your taxable income and directs them a full dollar amount to causes you care about the most. If you plan to leave money to your charitable anyway, this is almost always a more tax efficient way. Step 4, build a Roth conversion strategy with your heirs in mind. Not just your own retirement income. A dollar converted to today's Roth may pass to your children completely income tax free, removing the 10-year clock totally thing entirely. The right conversion amount depends on your brackets and your estate size and your heirs' circumstances, but ignoring the legacy diminishing may mean leaving significant portions of what you built to your IRS rather than to your family, which you don't really want. Here's the thing no one tells you until the accounts are actually in probate. The tax code does not distinguish between wealth you build carefully and the wealth you never got around to restructuring. A traditional 401k with no planning and one with careful planning look very different on paper, and it's totally different when you're dead. The difference shows up entirely on the back end, in your heirs' tax return for 10 years after you're gone. The trap doesn't announce itself, it just activates. You've worked so long and carefully to leave this valuable money to your kids or your heirs. Good news is you still have time while you're here. Bad news is the window is not open indefinitely. If you want help reviewing your beneficiary designations and thinking through how your retirement accounts will be treated under the current tax law when you pass, I'd love to talk through you and walk through your specific situation. Book a time with me at Uncommon Wealth Partners. The link is in the description below. Thanks again for your time, and we'll see you in the next video.